Hello everyone, Stephen Furness here, Director MGD Wealth, and in this capacity, head of our investment strategy group here at MGD. As per our ongoing commitment to client information and education, this is the latest version of our quarterly market update interview with one of our specialist investment partners. This time around, we're pleased to welcome Matt Wacher, who's Chief Investment Officer for Asia Pacific for Morningstar Investment Management Limited. Morningstar being one of our key research and asset consulting partners here at MGD Wealth for a very long period of time. Good to see you, Matt.
Thanks for having me, Stephen, and thanks again for all the trust you put in us.
Very good. You and your team continue to do a great job for MGD and our clients. For regular viewers of this style of update, quarterly update, Matt's been a contributor quite a few times in the past, so will be a familiar face to many. This has been recorded in early February 2026. A reminder for everyone, this is general advice information only. You should not construe any of these comments as that follow as personal financial advice. It's important, as always, to take your own personal advice through one of our skilled MGD client advisors here. So again, general information, general advice only in this presentation. We've got some slides here that you kindly provided, which really reflect on the year ended 31st of December 2025. And I thought we'd run through some of the key points here, obviously conscious of time. But also, January 2026 has been quite an interesting period. I took a couple of weeks off and a lot happened. So it would be great to maybe reflect on just what's been going on a little bit more recently since the end of December.
Not a problem at all, Stephen.
So we have. I'll get my screen working. Important disclaimer there from Morningstar, obviously reiterating the general advice issues. So geopolitics is always something that weighs on markets and commentators. And you could have a slide any time in the last how many years. There's always geopolitics at mind, but quite a lot still going on, Matt.
Exactly, and you mentioned January. Well, many of these things flared up in January. Indeed, Greenland, obviously the intervention in Venezuela in early January, and then more recently Iran, and then we have the ongoing kind of Ukraine-Russia conflict there. And what I would say with all of these developments and ongoing kind of issues is that more and more we're seeing the intertwining of kind of geopolitics and economic policy, and that's very much coming to the fore under the Trump administration. Certainly things like energy security, that kind of the intervention in Venezuela and the kind of purchase or takeover of Greenland, that kind of concept, and even in Iran, obviously potentially, or the threat of further intervention there. They're all, really about energy security, critical resources, and making sure that the US can shore up some supply chains. And what that does is not only there's lots of destabilization as other countries kind of wonder, well, what's our position in the world relative to the US? But it means that that adds to the volatility, adds to the risk sentiment, and we would say that leaving aside all of the the human issues, that go along with some of these things. It does create a lot of volatility, or the potential for volatility. That risk sentiment increases, and that can be a bad thing if we get severe market reactions, but it's also potentially an opportunity to take advantage of in markets if there is some volatility that stems from some of this. As we see some of these things develop, or potentially increase the volatility in markets, we would be probably more aligned to adding to growth assets at this point in time, as opposed to kind of thinking this is a complete risk-off environment.
Yeah, I do like the next slide here about what you sort of can control and can't control.
Indeed, and it's very related to the previous slide, I guess. Certainly, volatility could come from any of those geopolitical events, or any other geopolitical events that are yet to come, yet to happen, yet to surprise us about. But none of them, and the outcomes, the timing of any outcome, the timing of any new geopolitical issue, all very important potentially to markets, as you can see. The top line there, the important and unknowable, you want to be aware of those, but you probably, if they're unknowable, you need to be prepared, as opposed to trying to predict the outcome. And what we find is that if we're prepared to invest in those volatile environments by looking at valuation, what things like cash flows from companies or bonds, these are kind of much more knowable. They're nothing completely knowable, but they're much more stable than geopolitical events. And they're also very important to kind of long-term fundamental returns of companies. We want to be spending most of our time there so that we can prepare in case some of those unknowable geopolitical events, which are important, give us an opportunity to invest. What we don't want to do is obviously focus on anything that's unimportant and unknowable, and things that are knowable but not important. Again, we don't want to spend too much time there, because that's already priced into markets most of the time.
Yeah, exactly. So last year was every year is interesting. We had a lot of volatility early in the year, but overall for the calendar year 25, a good year for equities. Rebound continued in global infrastructure. So yeah, pretty solid year. I was looking at some index style investor returns just before this recording, and if you're a high growth assertive investor, you might have got running a diversified aggressive strategy, you might have somewhere between 12 to 14% for the year, possibly, whereas a more conservative investor might have delivered somewhere 5 to 7% for the year. But even for a conservative investor, given where cash rates are, a pretty nice buffer against the cash rate. So
exactly,
pretty good year. Volatile at times, but a solid year, no doubt.
Yeah, and certainly that volatility, as I've been saying, it presented an opportunity to take advantage of that. I guess the key thing here, Aussie equities have been a bit of a laggard. And international shares, if you look beneath the surface, it's really been a bit of a rotation there. We might get to that a bit later. But one thing I would say, looking at the kind of 5-year returns, so the 3-5-year returns, the 3-year and 1-year returns versus the 5-year returns, is that they've been pretty exceptional, and you don't get that kind of thing ongoing. You're probably going to get another, maybe not a 2022, which still is captured in these 5-year numbers, where markets do sell off. But yeah, you don't want to be banking future returns at this level into infinity.
No, totally. Certainly domestically, and probably all around the world, inflation's always a for people like you and economists to focus on.
Yeah, we try and not forecast the short term, but it is something that's very important to investing because we want to be outperforming inflation to make sure that investors, your clients, that we invest on behalf of can achieve their financial goals into the long term. So it's never too far away from things. And in Australia, obviously, there was the period where even 6 months ago where people thought that interest rates were still going to be cut, that inflation had been beaten, and that we were on the downward kind of, or it was tamed. Now that's obviously turned around since probably October. Things started to look a bit hairy for further interest rate cuts, and we got an interest rate rise obviously last week. There's some. It's a interesting environment for the RBA. There's some more recent data that's come out around consumer sentiment and business sentiment, things that aren't pointing all that rosier picture for economic growth in Australia. At the same time, inflation's remaining sticky. So they've got a very tight path to navigate. But we would say that it's more than likely they're going to be on hold for a little while, rather than kind of significant rate rising cycle. But it's an interesting environment for the RBA. I wouldn't want to be sitting on the RBA board making those decisions.
No, you got a lot of pressure, exactly, politically and otherwise.
Indeed.
The government bond yields. What's an important consideration when you look at these graphs?
Yeah, I mean, this chart is a really interesting one for all investors. May not look at a few lines on a page, but if you look back to kind of 2021, and if you were to go back another year, 2020, you'd see bond yields across the board were very, very low. Japan, Europe, pretty close to negative there, and Aussie and US yields, the yellow and the red on the chart, kind of 1%, and got much lower in COVID as well, in that COVID period of 2020. Now, they've increased quite significantly, and the Aussie has kind of gone up the most there, along with the UK. And what that has actually meant for portfolios is that, yes, conservative investors unfortunately felt a little bit of pain, particularly in 2022 as bond yields rose. But now you can build a much more diversified portfolio. It's not to say that bond yields may not increase more, but from this starting point, you can build a much better diversified portfolio, and potentially a much more robust portfolio for a range of different circumstances, with yields where you're getting, effectively, even with the inflation rises that we've seen, positive real yields, yields above the inflation level, which you weren't getting back in 2020-21. And the other important thing on this chart that I would say is looking at the green line down the bottom. Japan has gone from a deflationary environment for many, many years to stoking the inflationary fires. They've got a new, there was a political win by the incumbent Prime Minister on the weekend that's going to potentially shake things up even further. But bond yields in Japan, although they're not as high as other parts of the world, the change has been incredible over particularly the last year. And that has kind of thrown a few ructions into global markets. It's just another factor that's fallen into the geopolitical mixing pot there.
Yeah, absolutely. And looking at slide, you reflect on our conversations with our valued clients back in 21, and interest rates zero, more defensive parts of portfolios weren't generating returns.
Yeah,
and how that impacted on investment decisions. But yes, I certainly agree. It's a better environment for genuine diversification strategies now, which is pleasing. Just running through a bit of outlook or backdrop slides before we wrap up, Matt.
Yeah. Look, I think
emerging markets really recovered after a sort of few years in the doldrums last year. Emerging market equities.
So I think the next couple of slides will actually show a similar theme, albeit you're getting a bit more focused on the US. But the theme is that we had this period of market concentration. Big tech stocks. You could narrow it down to the big 7 tech stocks, the Magnificent Seven, doing very, very well, especially relative to almost all other parts of the market, whether they be US stocks, emerging stocks, or international stocks. But last year we've seen the emerging stocks, as you said, do very well. European stocks do very well, and starting to see US stocks lag. And if you were to focus on those US stocks, you would have seen that actually other parts of the market have done very well. Now, what we're looking at on this chart is the S&P equal weight index versus the S&P 500. Now, it's still the S&P 500 still outperformed last year, but we are seeing much better valuation opportunities beneath the surface. If you look beneath the kind of big tech names and lots of that AI trade, we are seeing some really good opportunities. And the period that was on that previous chart where there was a kind of long run of the equal weight outperforming the S&P, potentially we're set up for maybe not 6 or 7 years, but potentially we're set up for a few years of not to say that big tech stocks are going to give up performance, but outperformance by other parts of the market. This kind of concept of the rotation trade, whether it be internationally versus the US or large cap versus small cap, big cap in the US, we think that's given where valuations are, we think that's a theme that people want to have much more diversification in their portfolios at this point in time.
I would certainly concur with the comments. Not that they're falling over, but some of the heat has come out of parts of the Magnificent Seven.
Indeed.
More recently.
And if you were to roll forward kind of, even last week, maybe Microsoft wouldn't even be at 15.6%. It certainly got beaten up on the back of some of the sentiment around software stocks. Google and Nvidia certainly have led the way. They're obviously very big stocks. But what we've seen is that all of these stocks, Nvidia has been the recipient of capex spending, but all of these stocks have been spending a lot on capex, capital expenditure. Buying, building data centers, buying semiconductors, etc. And that's really meant that they've gone from very cash generative businesses, and not to say that they're still not going to generate a lot of cash, but they're starting to be, move from kind of these cash generative businesses to what we're calling kind of hyperscalers, where they're investing a lot in their future. And you can see here just actually it shows the level of spending, and that would even have to increase if we took into account reporting season last week. But you can see in the chart on the right here that dotted line, and that's kind of capex spending on AI, data centers, semiconductors, and it's just leapt up there a huge amount. And actually the expected spending is even higher than what we're seeing on this chart now, based on some of the reporting last week. And that's a huge amount. That's changed the nature of some of these companies that people thought they were, that they were very cash light and investment light kind of businesses. And so they are, the landscape is changing a bit, and investors out there, especially last week, it's changed a little bit this week. Markets are fickle, but it's especially last week they were kind of saying, okay, maybe we'll start penalising some of these companies for the spending that they're doing, and so we saw a bit of a sell-off in early February, and that's stabilised a bit. But if they're not able to deliver on the back of this capex, and that's uncertain how they're going to deliver, it will potentially lead to even more pain for some of these stocks, these big tech stocks, we would say.
Yeah. You and I, Matt, we've got grey hair. We've been around. We've been around a while, but some of these numbers just continue they just stagger me. Some of the level of spending, just the volume of capital and that. But,
Yeah, indeed.
anyway, so just probably we could wrap up on this slide.
Yeah, for sure. So maybe
where
this
to
is
from
really,
here? What are some of the things on your mind? And that'd be good.
So the way that we think about investing, as you might have gathered from previous sessions or even today, we really want to focus on valuation. What's the fair value of these companies, and really there's a wide margin of error in our calculations, but we want to understand that so that we can be prepared to take advantage of opportunities. And we would say that the bar is very high for some of those big tech companies, and some other opportunities, the bar is a bit lower. But we do want to make sure that we're not missing anything. Those fundamental risks, is there going to be some geopolitical situation that we need to be aware of? We don't know what exactly is going to happen, but we do want to understand the temperature in the room. As we were just discussing, where's the capital being deployed for the capital cycle there? Is there going to be a sufficient return generated for the capital being spent? We want to understand all of those three things. And then we're looking for, especially in this AI space, if there's been a lot of capital deployed, there's some risk there, the valuations aren't quite there. Well, what are the tangential opportunities? And areas that we would see, we would have said, 6 months ago that places like Korea and China had some very good tech stocks that you'd probably want to be invested in. They've run very, very heavily, and so we've kind of moved away from that. But that's where we're looking. We're looking for areas where they're not the direct beneficiaries of AI like NVIDIA, but there's other parts of the market that you could invest in. And some of those would be, there's opportunities in the healthcare sector, there's even consumer goods companies and others, but there's also a whole range of other types of tech companies that we're looking at. At the same time, there's more traditional companies that look, quite interesting, that don't necessarily have anything to do with AI. And again, the healthcare sector, on the back of kind of some of the reforms in the US or lack thereof, means that some healthcare companies have been beaten up, and there's some good valuation-driven opportunities there. And of course, with tariffs and kind of geopolitics playing their role, we see some good opportunities as well in some of kind of the luxury brands. With China's economy still in the doldrums, not much has to go right for a company like Louis Vuitton or Burberry to do very well. Valuations are very depressed there, or even a company like Nike. If it gets some good news, it's got some management issues as well, but if it gets some good news there, these companies could go up significantly from a very low base, and you don't have to take kind of that AI risk of something falling over there. So there's some of the ideas that we have in our portfolio at the moment.
Yeah, very good, and that's really encouraging, and that's what we expect from our large global consulting partners like Morningstar. So yeah, credit to you and your team.
Thanks,
that's
Steve.
really good, Matt. Appreciate the time today.
Thanks for having me.
Wishing you and your team a good and successful 2026, and continue looking after our clients' capital like you have been. So
we'll do our best. Yes.
Thank you very much, and thanks you everybody for listening in. As always, any queries or concerns on your mind, please reach out to your client advisory team here at MGD Wealth. Thanks again, Matt.
Thanks, Stephen. Thanks, everyone.